Joseph's College for Women Autonomous Vishakhapatnam. Welcome to St. Joseph's open web-based learning platform So eLearn for a soulful and enriching e-learning experience. Department of Commerce and Management, St. Joseph's College for Women Autonomous presents SMOOC, St. Joseph's massive open online course, Business Organization. Business Organization, Module 2, Promotion of Business, Chapter 2.6, Concept of One Person Company. I, Mrs. K. Pratyusha, Assistant Professor, Department of Commerce and Management, St. Joseph's College for Women Autonomous, Vishakhapatnam. Learning Objectives of One Person Company. The students will be able to know the concept of one person company, identify the eligibility criteria to start a one person company, understand the registration process, analyze the benefits and challenges, operational aspects of the company. What is a one person company OPC? A one person company is a unique business structure where a single individual owns and operates the entire company. This innovative model allows entrepreneurs to enjoy the benefits of incorporation while maintaining complete control over their venture. In simple terms, one person company is a private limited company which is fully held by shareholders and completely controlled by directors by one or single person. A single shareholder holds 100% shareholding, which means only one person is required to form an OPC, who can be both a shareholder as well as the director. A one person company is a type of privately held independent legal business entity similar to a private limited company, which limits the liability of the ownership up to the extent of the shares he or she has subscribed. It means the liability of shareholder to creditors or lenders of the company is limited to capital originally invested. The minimum and maximum number of members required to form an OPC private limited company is only one. The main features of one person company is independent and separate legal entity. And one person private limited company is established under Section 2, subsection 62 of the Companies Act 2013. Hence, an OPC is a separate legal entity in the eyes of law. Limited liability. Similar to a private limited company, an OPC private limited protects your personal assets with the limited liability feature. Maximum liability of the shareholder or director is limited to the extent of the shares held. Only one shareholder or member. Given the nature of the business entity, there can only be one shareholder or member in an OPC private limited at any given point of time. Hence, the only member owns the 100% of the shares in the OPC. No minimum paid up capital requirement. There is no minimum capital required to start an OPC private limited company. So, even with zero registered capital, an OPC can be incorporated and can start doing business. Uninterrupted existence or perpetual succession. An OPC private limited company has perpetual succession, which means it continues to do business even if the member changes or dies. Membership in one OPC at a time. A person can be a member of only one OPC Private Limited at any point of time. In case a person becomes a member in more than one OPC Private Limited, that person is required to withdraw from the membership of any of the OPC within 180 days. Registered rights and transfer of shares. Companies Act 2013 expressly restricts the transfer of shares of an OPC private limited company, which means the shares of OPC cannot be transferred to others easily without fulfilling various compliances. Benefits of starting a one person company. Flexibility, As the sole owner, you have the freedom to make decisions quickly and adapt your business strategy as needed. Tax advantages. OPCs enjoy certain tax benefits such as a lower tax rate and the ability to carry forward losses. Reduced paperwork. Forming a one person company requires less paperwork and compliance compared to the private limited company, saving time and resources. Separate legal entity. An OPC is a distinct legal entity providing liability protection and enabling you to secure funding more easily. Some are privileges of one person company. They do not have to hold annual general meetings. Their financial statements need not include cash flow statements. A company secretary is not required to sign annual returns. Directors can also do so. Provisions relating to independent directors do not apply to them. Their articles can provide for additional grounds for vacation of director's office. Several provisions relating to meetings and quorum do not apply to them. They can pay more remuneration to directors than compared to other companies. Eligibility criteria for forming an OPC. Residence requirements. Age limit. No other company. Nominal capital. Coming to residence requirement, the individual forming the OPC must be an Indian citizen and resident of India. Age limit. The individual must be at least 18 years of age to establish a one person company. No other company. The individual cannot be the nominee of another one person company or the director of any other company. Nominal capital. The one person company must have a minimum paid up capital of 1 lakh rupees and can have a maximum paid up capital of 50 lakh rupees. Registration process for an OPC. Choose a business name. Select a unique and available name for your one person company. Obtain Director Identification Number DIN. Apply for a Director Identification Number with the Ministry of Corporate Affairs. File incorporation documents. Submit necessary documents and forms to register your one person company. Pay registration fee. Pay the required fees to complete the incorporation process. Obtain company PAN and TAN. Apply for permanent account number and tax deduction account number TAN. The registration process of a one person company involves several key steps, including choosing a unique business name, obtaining a director identification number, filing incorporation documents, paying registration fee, and obtaining necessary PAN and TAN numbers. This structured process ensures compliance with government regulations and lays the foundation for your new business venture. The documents required for registration process are duly filled application form with passport size photographs of the owner, copy of Aadhaar card and voter ID card of the applicant, owner's PAN card, property papers and rent agreement if the property is rented, company's utility bills like electricity, water, etc. NOC from landlord. Any other document required by registrar or firms. Let us see stepwise registration process briefly. Step 1. Apply for Digital Signature Certificate DSC and apply for Director Identification Number and then select and file for name approval application with Ministry of Corporate Affairs. Draft Memorandum of Association and Articles of Association and to be signed by the applicant. Gather and submit all the required documents along with registration fee and stamp duty. Filing and approval of application forms with MCA. Obtain the issue of certificate of establishment or incorporation. Taxation and compliance requirements. Minimum paid up capital. The minimum paid up capital requirement for an one person company is 30,000 rupees. A one person company must file two annual returns, an annual return and a financial statement. Compliance costs. The estimated annual compliance cost for an OPC are around 14,000 rupees. One person companies are subject to specific taxation and compliance requirements set by the government. The minimum paid up capital to register an one person company is 30,000 rupees. One person companies must file two annual returns, an annual return and a financial statement. The estimated annual compliance costs for an OPC, including accounting, auditing, and regulatory fees, are around 14,000 rupees. Operational aspects of running an one person company: running day to day operations, regulatory compliance, client relationships. Coming to running day to day operations. As a one person company, you will be responsible for all aspects of running the business, from managing finances and clients to handling administrative tasks and making strategic decisions. Regulatory compliance. Ensure you comply with all relevant laws and regulations, such as paying taxes, submitting annual filings, and maintaining proper licenses and registrations. Client relationships. Build strong relationships with your clients, provide excellent service, and continuously look for ways to expand your customer base and generate new business. Advantages of one person company over a sole proprietorship. Legal separation. A one person company provides legal separation between the business and the owner, offering better liability protection. Credibility. The one person company structure lends more credibility to the business, making it easier to open bank accounts and secure financing. Tax benefits. One person companies offer more favorable tax treatment compared to a sole proprietorship, with the potential for greater deductions. Challenges and limitations of one person company: operational complexity, growth limitations, funding challenges, succession planning. Despite its simplified structure, an OPC still requires adherence to legal and compliance requirements, which can be daunting for a solo entrepreneur. Growth limitations. The one person structure may constrain an OPC's ability to scale and take on larger projects or clients, limiting its growth potential. Funding challenges. Accessing external funding can be more difficult for an OPC, as it may be perceived as a higher risk investment compared to a traditional company. Succession planning. The lack of a clear succession plan for an OPC can relate uncertainty and challenges when it comes to the long term sustainability. Few more disadvantages of an OPC: requirement to appoint a nominee for incorporating a one person company. The very purpose of an OPC is so that an individual, by him or herself, can start a business with limited liability without the need of having a partner. Though the provision of appointing a nominee was introduced with the objective of perpetual succession, this creates a lot of procedural hassle for selecting a suitable nominee, obtaining his consent, etc. Further, the nominee also has a choice to withdraw their consent to their nominations, thus creating even more complications in the form of requiring the founder to nominate another person within 15 days from such withdrawal, intimating it to the company, amending the memorandum of the company, and further communicating such fact to the registrar of the company also. Ownership limitations. Only a natural person who is an Indian citizen and resident in India shall be eligible to incorporate a one person company. The person incorporating the one person company must be a natural person, implying that it cannot be formed by a juristic person or an artificial person. Example: any type of company incorporated under Companies Act 2013. This restricts the ownership of only individuals and not corporations. This provision also discourages foreign direct investment by disallowing foreign companies and multinational companies to incorporate their subsidiaries in India as a one person company. Hence, and one person company will have to change their legal status to a private limited company to bring in investors. Foreigners and NRIs are allowed to invest in a private limited company under the automatic approval route where 100% FDI is available in most sectors. Restrictions on conversion. An OPC cannot be incorporated under Section 8 of Companies Act 2013. An OPC is also not allowed to carry out non banking financial investment activities. ESOP. Since an OPC can have only one shareholder, there can be no sweat equity shares or ESOPs to incentivize employees. A private or public limited company can easily expand by an increase of authorized capital and further allotment of shares to even third parties. Hence, a private company is preferable option for startups who want to encourage their employees by way of stock options. Transitioning from one person company to a private limited company. Evaluation. Assess the business's growth potential and long term objectives. Legal conversion. Convert the one person company structure to a private limited company. Operational changes. Implement new organizational structure, management, and compliance. As a one person company grows and matures, the founder may decide to transition to a private limited company structure. This involves carefully evaluating the business's long term goals, legally converting the entity, and making operational changes to accommodate the new corporate structure and increased compliance requirements. Future outlook and trends for one person companies. As the entrepreneurial landscape continues to evolve, one person companies are poised to play an increasingly significant role. Experts predict a rise in the formation of OPCs, driven by the flexibility, reduced bureaucracy, and opportunities for individual growth they offer. Emerging trends suggest that OPCs will become more prevalent in specialized knowledge based industries, allowing solo entrepreneurs to leverage their expertise and capitalize on niche market opportunities. Additionally, the increased adoption of remote work and digital tools is expected to further facilitate the success of OPCs. What is one person company? OPC. A one person company is a unique business structure where a single individual owns and operates the entire company. This innovative model allows entrepreneurs to enjoy the benefits of incorporation while maintaining complete control over their venture. Let us see what we have learned. Benefits of one person company, eligibility criteria, registration process, etc. Understand the advantages, taxation, and challenges. Future trends of one person company. Thank you.